Navigating high interest rates. Obviously, the interest rate environment we are in 2024 is a lot different than what we were in 2020 and 2021. I don't ever see rates getting back down to 2.5, 3.5%. I don't know that they'll ever drop back down to 4. But we are in a more normal rate environment. So if you go back historically and look at what interest rates have been, where we're at right now is a pretty common ground. And it's still strategically a very low interest rate when you think back to the teen interest rates that people in the 70s were facing. So, how do you make the increased interest rate environment work on your behalf? First thing is, if you are out looking for a home and you have been talking to your loan officer and they tell you, well, rates have kind of been edging up lately, you may want to go ahead and lock your rate in early so that you don't end up paying 1/4 or 0.5% higher because you waited too long to lock your rate and interest rates moved up. So talk to your loan officer, find out what's trending right now. Are rates kind of staying stable? Are they decreasing a little bit? Or are they ticking upward? Make your lock decision based on the information they provide you. Second thing, now this is probably not going to work for a first-time home buyer, but if you're looking to move up or move down, you might want to consider an adjustable rate mortgage. A lot of the credit unions in the area have some adjustable rate programs that will run about 1% lower than a 30-year fixed mortgage. So how does an adjustable rate work? Typically, your rate is going to be fixed for a specific period of time, normally 3, 5, 7, or even 10 years. And then at the end of that term, the rate will adjust, typically based on prime plus whatever index they have. Most people don't stay in their home 7, 10 years. So the thought process is that either A, you would sell your home and move to a new one before the rate adjusts, or if rates do come down on 30-year fixed mortgages or even a 15-year, if that's what you prefer, you can always refinance into the fixed rate loan product. Now, I did mortgages back in the 2000s, and that's when adjustable rate mortgages really got a bad rap. And that was for a lot of reasons. Number one was the subprime lending practices. That was how people with 560, 580 credit scores who had never paid anybody on time in their life were able to get into a home. There was 100% financing available, and we would put them on a 228 mortgage so that their interest rate was halfway affordable. But most of the time, that 228 mortgage carried a 3-year prepayment penalty, which meant that if they refinanced it after the 2 years, they were going to pay a penalty. And we always said that gives you 2 years to work your credit back up, build your credit score. Nobody did it. So that's why adjustable rate mortgages got a bad rap. If you're looking at a product with a 5, 7, or a 10-year term before that rate adjusts, and you have good credit, I don't think you're going to have to worry with doing an adjustable rate mortgage. You've got more financial savvy to you than someone with a 560 credit score getting into a house with 100% financing. Third thing I'm going to tell you in order to navigate this high interest rate market is to either save money up to do a buy down of your interest rate or negotiate with the seller in the contract to have them buy the rate down for you. So there's a couple of different buy down programs. Some mandate that the seller pay the buy down. Some allow the buyer to pay the buy down. So you just need to talk to your loan officer, see what those scenarios look like. I would look at what the monthly payment savings is versus how much you're having to pay out. If you're going to recoup that in a 2 to 3 year time period by buying the rate down, then I definitely think it's a worthwhile investment for you. If you're worried about the interest rates and trying to sell your home and buy a new one, give me a call. Let's have a conversation one-on-one.